Hi everyone, welcome again. In this video lecture we are going to look at the capital allowances. In the previous video lecture, if you remember, we made the trading profit adjustments. So trading profit for accounting purposes was different, as I said, but for tax purposes it is quite different. So tax authorities say that just take the accounting profit and then make some adjustment to it, add some expenses which are deducted already from accounting purposes, add them back. There are few expenses which are not deducted, just deduct them. There are few incomes which are not included, which are taxable but which are not included there, add them. There are few incomes which are added there and just deduct them. So there are four types of adjustment in our trading profit when we made the trading profit adjustment in our previous video. Now in this lecture, as I said, we are going to look at the capital allowances. Now if you just remind yourself of the trading profit adjustment, we used to add back the depreciation. You remember? So depreciation, for our accounting purposes, we just deduct the depreciation while making the income statement. We deduct the depreciation. However, for tax purposes, they say that depreciation is not allowed. Just add back the depreciation. So we used to add back the accounting depreciation, but we used to deduct the capital allowances. Now if you're still not sure, just go back to your trading profit adjustments and see there we are adding back the depreciation, but we are deducting the capital allowances. Depreciation and capital allowances is basically exactly the same thing. Depreciation is for accounting purposes, whereas capital allowances is for tax purposes, right? Anyway, that is not our topic. We have already seen these differences in our basis period anyway, and we are not studying the deferred tax anyway. So anyway, this is capital allowances, as I said. Capital allowance is basically depreciation for our tax purposes. Now depreciation is calculated in different ways, as we know. One of the method is reducing balance method. We know that there is straight line as well. There used to be sums of digit method as well, which is no longer allowed by the standard. But we know that we can calculate the depreciation by using the reducing balance method. Now for tax purposes, we will only be using this we'll only be using the reducing balance method for depreciation. So there will be few plants and machinery which we are purchasing, and we have to calculate the depreciation on that. It will be on the reducing balance method every year. So whatever the plant and machinery's value is, we'll calculate the depreciation. I will tell you what are the rates. So we'll calculate the depreciation. Whatever the remaining balance is, that will be carried forward in the next year, and then we will calculate we'll calculate the capital allowance in the next year as well. Right? Now I'm going to share the notes with you through the screen share option, so that you can just see the notes as well. If you could please open up your notes and open the chapter of capital allowances, please. Right, capital allowances. Excuse me. Now in the capital allowances section, first of all it says that writing down allowance. So there are, as I said, there will be different depreciation rates for all of these. There will be different tax rates for the different assets. We can purchase some cars, we can purchase some plant and machinery and stuff like that. So there will be different rates for all of them. We can purchase some other asset like laptop or a computer as well, right? So there will be different assets which we will be purchasing, and there will be different tax rates for all of them. So first of all, first one is writing down allowance. So writing down allowance of 18% per annum. This is 18% is per annum. On reducing balance is given on plant machinery in each accounting year in the main pool. Now there are different pools. I've shown them on the board as well. So there are different pools. Now if you just rewind the video when I was in a bigger version, now it might be on the corner in the left side of the screen, because I have already shared the notes with you. So if you just rewind the video, or when at the end of the video, you might be able to see on the board as well. So there are different pools. Whenever we buy an asset, we will put that in a specific pool. If we buy a plant and machinery, we will put that in a main pool, right? So that's what we are talking about. Writing down allowance will be at the rate of 18% per annum on the plant and machinery in the main pool, the plant and machinery which will go in the main pool, right? So we will see later that which plant and machinery goes in the main pool. Anyway, sometimes accounting year is less than or more than 12 months. If it is less than or more than 12 months, then obviously we'll have to adjust this percentage of 18%. So 18% multiplied by months over 12. So if the months are more than 12 months, then whatever the months are over 12, excuse me, and if the months are less than 12 months, then whatever the months are over 12. No writing down allowance is given in the plant and machinery disposed of during the accounting year. What the rules say that whenever you purchase the plant and machinery, you will give the full writing down allowance in the year of purchase, whereas no writing down allowance in the year of sales. So that's why when we are selling an asset, when we're selling a plant and machinery, in the year of sales, there won't be any writing down allowance. Excuse me. After that, there is annual investment allowance. Now, annual investment allowance is lump sum £200,000 every year. So if you spend £200,000 on plant and machinery, that will come under annual investment allowance. All right, so that is a straight depreciation, that is a straight capital allowance. So we will be calculating capital allowance in the different ways. One is annual investment allowance, then it's writing down allowance, and then after that, after finishing the question, we will accumulate the total capital allowance, which will go in our trading profit, which will be deducted from our trading profit. Right, so the annual investment allowance, business can claim annual investment allowance on the first £200,000 spent on the plant and machinery. And this limit is, as I said, is for per year. So if the accounting period is more than 12 months, then obviously we'll have to adjust that. And likewise, if it is less than 12 months, we'll have to adjust it as well. Now, after calculating annual investment allowance, if there is any value left in the plant and machinery, if there is still anything left, say for example, the plant and machinery was more than £200,000, it was £250,000. So first £200,000 will be under annual investment allowance. The remaining £50,000 will go in the relevant pool, and writing down allowance will be given. All right. So writing down allowance will again be given on the same asset, same plant and machinery. And finally, it says that it cannot be claimed on the cars. If you have purchased a car, annual investment allowance cannot be claimed on the car. It is only on the plant and machinery. Right after that, it says first year allowance. Now, first year allowance is given only on the cars which are emitting less emissions towards the environment. First year allowance of 100% available on purchase of cars with low emission of 75 grams per kilometer or less than that. This information will be given to us in the question, that what are the CO2 emissions of the car. So if it is less than 75 grams per kilometer, it will be 100% capital allowance. It is first year allowance of 100%. Now, first year allowance means whenever we have purchased this car. The first year allowance is not reduced, and it is not like we do in annual investment allowance and the writing down allowance. It cannot be prorated. It is just fixed amount. Doesn't matter the year is less than or more than 12 months, it will not be on the prorata. Then it says special rate pool. Expenditure, if we spend certain expenditure, if we have done certain expenditure to the building, if we have improved something in the building, them expenses will go into the special rate pool, where the 8% per annum writing down allowance will be given. 8% writing down allowance. Now, the writing down allowance, normal writing down allowance in the main pool was 18% per annum, whereas in the special rate pool it is 8%. Right? Now, it is not only on the improvement which we have done to the building, it is also on the special cars, the cars which are emitting more emissions towards the environment. The cars over 130 grams per kilometer. Now, as you can see in your notes, expenditure on thermal insulation, solar panels, long life assets, features integral to the building, and cars with CO2 emission over 130 grams are included in the special rate pool. These does not go into the main pool. These go into the special rate pool. All right. And after that, it says that cars. I've already explained as well for the cars as well. Cars which emit over 130 grams per kilometer will also go into the special rate pool. Then it says write-down allowance of 8% per annum is given. Of course, if the year is less than or more than 12 months, we'll have to adjust that. Now, annual investment allowance, which we have seen earlier, it will be given against the special rate pool first, and then to the main. Why? Because in the special rate pool, writing down allowance is 8%, and in the main pool, writing down allowance is 18%. So we do not want to waste our annual investment allowance. Best use of annual investment allowance is to use it first against the special rate pool, and after that use it in the main pool. Right? Then after that it says long life assets. Now long life assets are where the life is over 25 years and their value is over £100,000. And then after that it says that what are the integral features to the building. Now above that we have studied in the special rate pool thermal insulation, solar panel, long life assets, and the features integral to the building. Now it is explaining what are features integral to the building. Electric and lighting system, cool water system, space and water heating system, power system of ventilation, and there are a couple of more as well. Alright, so if these are given in the question, we have spent some money on these, then this will go into the special rate pool. And remember, annual investment allowance will be used first against the special rate pool and then against the main pool. Right? Now if we come to the next page, on the next page it says that plant and machinery with private use. Now sometimes what happens is that plant and machinery is used privately by the owner, by the proprietor. Now private use of the proprietor is private use, however private use of the employee is not a private use, it is a business expense. Alright, so it says if there is a private use of the plant and machinery by the proprietor, not employee, only for the proprietor, then capital allowance is calculated, although we calculate the capital allowance in the full price, but only the business proportion of capital allowance can be claimed. Right? So whatever the private used asset is, another thing is that we will have to list that separately as well. So we will make different columns as I have made on the board, and in the question it will tell that this asset is used privately by the owner or the proprietor, and it will also tell you that how much percentage is private use. Although we will calculate the full capital allowance, be it 8% or 18% or whatever, we will calculate full amount, but we will then take only business portion of that. Alright? So after that we will only take the business portion. Right? And it says it is not applicable for the companies. Now why doesn't it apply to the companies? Because in companies shareholders are the proprietors. So shareholders are normally the proprietors, and who shareholders are not normally involved in the business, so they won't be using anything for private use. Right? Now such assets must be kept separate, as I explained you earlier as well. These assets which are privately used by the proprietor, these are kept separate, kept separately, and we will make separate column for that. After that it says balancing charge and balancing allowance. Now please remember, balancing charge is when we have made a profit. Now, sometimes what happens, we have purchased an asset and then we sell an asset. In the question it will say that we had that asset but now we are going to sell it. Now whatever the carrying amount is, if we are selling more than that, then we are making a profit. If you are making the profit, that is a balancing charge. However, if we are selling it at a loss, whatever the carrying amount is, we are selling less than that, that is a balancing allowance. Alright? So it says on sale of plant and machinery, a balancing charge or a balancing allowance will be calculated. When an item of plant and machinery is sold for calculation purposes, sales proceeds are taken as lower of sales proceeds and original cost. Normally, balancing charge or balancing allowance will not be calculated for the sale of asset in the pool unless all the assets in the pool are sold. Right? Now, what does it mean? It says that because we are going to make a separate pool for the private used asset, so there will be separate column where we will list all the privately used assets. And whenever we are going to calculate the balancing charge or balancing allowance, we will have to make sure that all the assets in that pool are going to be sold. If only one asset is going to be, if we are only going to sell only one asset out of that pool, then the balancing charge and balancing allowance will not apply. It will only apply if we are going to sell all of the assets in the same pool. Right? And after that it says small balance claim. Now what happens is we will be given some information, then we will be calculating the capital allowance. So say for example it was £100,000 and the capital allowance was £20,000, the remaining amount is, because it is on the reducing balance method, remaining amount is £80,000, which we will carry forward in the next year, and again in the next year we will calculate the capital allowance again. Likewise, we will keep doing it. Now the time will come when the carrying value of an asset or the plant and machinery will be less than, if it tells you at the start of the question that the carrying value of a plant and machinery was less than £1,000, then whole amount will go in the capital allowance. We do not have to take 18%, 8% or whatever. It is called balancing allowance. Now if the balance in the main pool or the special rate pool before claiming writing down allowance remains less than £1,000, then the entire amount in the pool is written off instead of the carrying forward. And after that, it says assets purchased and sold in the same accounting period. Sometimes we purchase and sell the asset in the same period. In that case, there won't be any capital allowance. So if an item of plant and machinery is purchased and sold in the same period, then no annual investment allowance or the writing allowance can be claimed on such assets. However, balancing charge or balancing allowance may be calculated on the sold assets. And on the next page, it tells the information about the cars. So if we purchase a cars, what would happen? Now cars are different. Cars are of different types. We've already seen one in the first year allowance. A car which is emitting less than 75 grams will go into the first year allowance. It will be 100% capital allowance. The next type of cars were where they are emitting more than 130 grams. Them cars will go into the special rate pool where the 8% relief will be given. Capital allowance will be given. Now the cars from 76 grams to 130 grams will go into the main pool. And we know that capital allowance rate in the main pool is what? 18%. So it will be at the rate of 18%. Now after that, if we see, if there is a private use of the car by the proprietor, again it tells us by the proprietor, not by the employee, then the capital allowance is calculated on the full cost, but only the business proportion of the capital allowance can be claimed in order to deduct it from the trading profits. And again, it does not apply for the companies. Now again it says that the private used assets must be kept separately, and no annual investment allowance is given on the cars. And there are some short life assets as well. Just after that, that is our last topic, short life assets. Now some assets we purchase and then sell within 8 years time. Now if we purchase an asset and we sell within 8 years period, that is called short life asset. These are the assets which the company wishes to sell within 8 years after the accounting period of purchase. The company may elect to keep such assets separately for calculation from the plant and machinery, and this method is called depooling. Now the assets which are short life assets which you intend to sell within 8 years, you can keep them separately. If you keep them separately, this process is known as depooling election. And depooling election, such an asset is called short life asset. Now annual investment allowance can be claimed against the short life assets. It is advisable to claim annual investment allowance against the main pool first, then against the short life assets. Right? Now it says that annual investment allowance will be calculated in the main pool first, then in the short life assets, which tells me three preferences of annual investment allowance: first against special rate pool, then the main pool, and finally against the short life assets. Writing down allowance of 18% multiplied by a months over 12, or 8% depending on which type of asset is it. Writing down allowance is 18% or 8% multiplied by months over 12. So in this asset, in this category short life assets, it could be either 18% or 8% depending on which type of asset is it. If it is plant and machinery which is going into the main pool, then it will be at the rate of 18%, or say for example it was integral features of the building, then it will go into the special rate pool, and of course the rate is 8%. But we are assuming that it is a short life asset, so we'll be keeping them separately because our intention is to sell them within 8 years period. Right, so we'll keep them separately. Anyway, and finally it says that cars cannot be elected as short life asset. So there is an exception to the short life asset. If you say that I've purchased a car and I'm intending to sell it within 8 years period, then that's not right. You cannot keep it separately as a short life asset. Right? And on the next page it says comprehensive example, which we will be doing in our next video. I I'll see you in the next video, and we will do our example.